In this video, we're finally getting away from our inventory and cost of goods sold, and we're moving into something a little bit different. We're going to be looking at accounting for receivables here. And we start off with a quick little review. What exactly is a general ledger? And can you recall what exactly these two things mean, 215 and N30? Pause the video and see if you can answer. A general ledger is where we take our journal transactions and we post them to, and they get posted to a general ledger, which is a whole bunch of accounts. So it's a collection of accounts where we get to see the debits and credits of each account. And the 2/15 and 30 have to do with accounts receivable or accounts payable. These are the terms. So it says that if you pay the balance within 15 days of the invoice date, that you get a 2% discount, and the whole balance is due within 30. But what we don't know is, well, what exactly is a subsidiary ledger, and what happens if those accounts receivable or payable is not paid in time? And finally, how exactly are credit card sales recorded? That is what we hope to address here in this lesson. Moving on, we're looking at accounting for receivables. So what exactly is a receivable? Well, they're amounts due from individuals or other companies. And we have accounts receivable, which are usually expected to be in the current assets because they're expected to be paid within 30 days. Now, on the other side of things, we've got things called notes receivable, and they are expected to be longer than 30 days. So actually what will happen is over time, these notes receivable eventually shift into those accounts receivable, and we expect that this collection time is 30 days or longer. So these could be listed as long-term assets. And finally, we have trade receivables. It's a common name for receivables from sale transactions, but I don't think we get into that too much in this course. A subsidiary ledger, let's take a look at that, is a group of accounts that share common characteristics. And we really haven't discussed it in anything else before this, but imagine all those purchasers. Imagine if you're Best Buy, you're buying from a Lenovo, you're buying from Samsung, you're buying from Apple. And so sometimes what you're going to want to do is you're going to have accounts receivable or accounts payable, depending upon what you're doing with it. And you're going to have a collection of all those things, and eventually those accounts all just get kind of combined into one account receivable or accounts payable. And it allows the general ledger to be free from details of individual balances. So for example, when you post up your financial statements online, they don't know who you owe money to or who owes you money. And that's what we call a control account. The account which is recorded in the general ledger. So that's what we call the accounts receivable one. But we may have accounts receivable, Apple, accounts receivable, Samsung, and so on. Accounts receivable GE, accounts receivable LG. And so the control account just basically amalgamates all of those accounts into this one. And the sum of the subsidiary accounts, the smaller account, should be equal to the value of that control account. So if, for example, there was a debit of $1,000, that the accumulation of all these accounts here should also have a debit of 1,000. So here's an example. Inventory has a separate ledger to keep track of items sold, except, when we put it in there, that's our control account. We don't have to keep track of every single little item. Accounts receivable, payable keep track of various debtors or creditors. Here's our first example. On October 5th, Best Buy buys $3,000 worth of computers from Asus with terms 2, 20, and 30, and a penalty of 15% annual interest. November 31st, the bill has not been paid. Dun dun dun, that's not good. Prepare the journal transaction for Sony for the interest. So we're only looking at this interest, it looks like in this example. So I'd encourage you to pause the video at this point and see where exactly you go with this and if you can figure it out. Now that you've had a chance to take a look, let's go through what exactly is involved. So we had October 5th. It was due 30 days from that. Roughly, we're looking at November 31st. The bill has not been paid, so that means roughly 1 month has gone by. And so we're just going to generalize, and we're going to estimate that to be 1 out of 12. Why 12? Because there's 12 months in a year, and we're rounding this to the nearest month. In fact, if you're doing this in practice, I'm sure there's a computer system that is tracking the number of days, and it's automatically generated. Where do these numbers come from? Well, the $3,000 is what it is owed, and the 15% comes from the annual interest rate, and our 1 out of 12 comes from, well, 1 month after the bill was due, that N30. And so when we end up taking this, we have to have this as, well, what exactly are we going to do? We're going to have a debit to accounts receivable Best Buy because we still expect to get the amount plus this here. And then we're going to have something called interest revenue because that's now money that's coming in. So if you didn't know what accounts were going to come up here, that's okay because this is your first time to see this. Now, I'll get you guys to try this on your own. A second example. October 5th, Best Buy purchases $4,000 worth of laptops costing $2,000 with terms 2, 15, and 30 and an annual penalty of 20%. $1,000 is paid to Sony on October 21st. November 31st, late interest is recorded. Journalize for Sony. All right. Give yourself a chance to go through this. It'll probably take you a good 5 minutes to attempt it on your own to start. Let's begin with this very first one. October 5th, we have purchase on account, and we're doing this for Sony. So Sony purchases stuff, which means they have an account, Best Buy purchases stuff, which means it's an accounts receivable of $4,000 from Best Buy. So there's our accounts receivable will be here, and we made a sale, so our credit will end up being sales of $4,000. Now, we're not away from our inventory yet. We still have to, remember, update our cost of goods sold and the inventory amount. Remember, whenever we sell stuff, it requires 2 journal transactions. One to show how much we actually sold, and the second to adjust the inventory. So inventory goes down by, in this case, costing $2,000. So inventory will go down by $2,000, and our cost of goods sold will end up being debited $2,000. So there's our next transaction. We have this payment which happens on October 31st. So now we're October 21st, which will go here. And since we're paying it, it's being paid with bank, and our bank account, since we're receiving it, goes up by $1,000, and the accounts receivable from Best Buy goes down, which means we're crediting it $1,000. Now, here's the tricky part, and this is what's new here. So this is a good refresher of everything you've done before. What happens with the interest? Well, we are now 1 month afterwards. We've got 20% interest, and our current balance is not $4,000, but it is in fact $3,000. Why? Because we've already paid or been paid $1,000. So we're going to calculate the interest as being $3,000 times 20% times 1 over 12, or divided by 12, same thing, and that works out to $50. So returning back to that, that means that our accounts receivable ends up going up by $50, and we have interest revenue of $50. If you guys got this from start to finish, great job. If you didn't get every single little detail, don't worry about it. It is tricky stuff, and it will take some practice. We move into things called credit cards, and if you didn't know this, every single time you use a credit card, there's a small fee that goes to the credit card company, and they're taking on the risk of customers not paying, and it's also adding that level of convenience. And typically within Canada, that fee for service is 1.5 to 3%. So let's go into an example that we start to see here. Here's our first credit card example. Ron makes a sale of $2,000 with Visa on October 21st. The cost of goods is $1,500, and the credit card charges a fee of 2%. Visa pays Rona, did I say Ron earlier? Rona. Visa pays Rona on October 31st. Journalize the entries that affect the accounts receivable. I'd encourage you to pause and at least think about this. You may not get everything right, but give it your best shot. You'll learn quite a bit more by making the attempt and seeing if you're right, rather than just waiting for the answer to come up. Right now, here's what we do know. We get $2,000, of which, of that $2,000, it has a credit card fee of 2% that goes back to Visa. So we're going to need some sort of new account to account for that $40. Where does the 40 come from? Well, 2,000 times 2%, that's the amount that will go to Visa in this case. And our sales hasn't really changed. Our sales is still $2,000. So let's take a look at our first one. Accounts receivable Visa, $1,960. And our credit card expense will end up being $40. And our sales is $2,000. And eventually we end up getting that amount on October 31st. So in this case, when we get that money from Visa, that means that we get Our bank account will go up by 1,960, and it takes us off the books, which means our accounts receivable is then wiped clean. 1,960. So again, if you didn't get that, no problem. Let's give you guys a chance to see if you can do this one on your own. So pause the video, see if you can do this. It does get a little bit more tricky because I added in some HST here. Oh boo. But there's probably going to be some sort of interesting twist to this. Alright. Now, having had a chance to pause the video and see, on October 15th, Home Depot makes a sale of $1,500 plus HST with MasterCard charging 3% service fee. October 31st, Home Depot receives cash from MasterCard. Journalize the entries involving the accounts receivable. Well, how much do we expect to receive? We know that we have $1,500 and our HST in Ontario is 13%. So we're going to have some sort of a credit or HST payable, which will be credited down here, and 13% of $1,500 will be, I think, around about $195. Yes, I'm looking off of another screen, which I've got a calculator going on here. Our accounts receivable will then be the $1,500 plus that $195. But we have to also deduct the 3% sales. So here you go. This is what we've got going on. 3% of that total, $1,500 plus $195, works out to $50.85. The accounts receivable is then that $1,695 minus the $50.85, which works out to $1,644.15. And the HST payable is going to be 13%, which is $195, and our sales is just $1,500. So this actually is the trickiest one out of all of these things, and the final one is actually a little bit easier because, well, we get the money, which means that we clear off this accounts receivable. So the credit of $1,644.15, and our bank is going to be debited. I do not know why my number is down here, but it should be one spot up. Tricky stuff. Again, things will get easier as you do more practice. Here you go. And that is your practice. If you ever have any questions, feel free to reach out. I'd be happy to answer them. Enjoy for now.